It's finally happening. We've got negative year-over-year rent growth and monthly rent declines nationwide for the multifamily industry. Are things finally cooling down in the commercial real estate market? Certainly from a valuation perspective, rents now also moving back down after seeing a really slow start to the year and end of last year. I mean, that is the biggest topic in breaking piece of research that we are covering this week on the Great Report, a report from RealPage we're going to get into in just a little bit. But from elsewhere around the commercial real estate world, Marcus Millichap has a report, a national report for the third quarter of 2023, getting some unique market insights, a lot of capital market pieces. Another one from Apartment List, their national rent report. CBRE also has a piece on multifamily rent growth to persist where least expected. So we're going to see, where different regions, which markets are breaking out, which ones are doing better than others. And then from the Harvard Joint Center for Housing Studies, local population growth dependent on migration and immigration. Want to make sure we are not stagnating. If you're a multifamily investor, really any type of investor, active, passive, you're in the right spot. We're breaking down all the latest trends and research affecting real estate, housing, the economy, breaking it down also with original opinions from the Great Capital team. A lot of really monumental reports to go over on this week's episode. But also, before we get into that, we're going to be going over some of your comments that you have posted on YouTube. So make sure you have liked this video, subscribe to the Great Capital YouTube channel, and leave your comment on this video. And we will get back to you, respond, and let's all put it into the conversation. So, all right, we've got a great show. Let's get into it. All right, bringing it back in.
Hello,
Matt. How's it going?
Pretty good. There's a couple things, and I know you said this earlier, but we got to get a handle on rent growth. There's a couple things that have crystallized in ways that looks like the cool down's here.
Yeah, and, I think we started seeing bits and pieces of it of just slowing down a little bit earlier.
Yeah.
And some pullbacks, with all these deliveries of units throughout the Sun Belt, all over the nation, but especially in a big way in some of the larger investment markets down in the Sun Belt. It's really affecting occupancy. Yeah. And that's going to affect rent growth because lower occupancy, people are going to start, it's really not going to be pushing rents.
And what's really interesting, and it is kind of stands in almost for the market as a whole, is the supply that's coming into the Sun Belt is going to be absorbed over time because population growth is so healthy there. And those are the areas that have gotten the most new supply. Things can get handled, but the next 1 or 2 years is going to be a little bit more modest rent growth, and renters are going to have an easier time renting in those areas.
Matt, it's so interesting being at the intersection of micro and macro economics, because on one hand, on the micro, we are laser focused on very specific markets and assets and certain asset class in the economy, multifamily market or apartments, and there's so much relation to just general housing. So we're looking at housing all the time, and sometimes housing is such just a consistent thing that it kind of is just going on in the background. Yeah. And even though it's a big part of the economy, it's not the one thing that's going to move things one way or the other, because it's kind of just a steady force. And since it has gone through so many changes, most importantly because of what the Federal Reserve started doing, almost 18 months ago now, more than a year ago, housing is now at the center, and rent growth and asset growth, really those forces behind housing, because there are so many other industries and part of the economy that are kind of tied to housing. There's so many financial derivatives related to housing. It is such a big part of our economy that has been specifically targeted by the central bank. Yeah, and seeing it firsthand granularly. So where I'm tying this back into this, the new report from RealPage is that typically we would see just a quarterly or monthly, rent growth report. It's kind of like, it's on a general trend that we've been used to. Mm-hmm. And it's kind of like, okay, yeah, that's a national projection. That doesn't really mean that much to just like us on our day to day, but just it's good to know.
Yeah.
This is really important related to the general direction of inflation and the economy, what the Federal Reserve is going to do or may not do, and what investors may or may not do.
Mm-hmm.
And because if what you're saying and what RealPage is suggesting is that we're going to have relatively, kind of moderate rent growth because of all these deliveries, that's going to, again, housing takes up, is more than a third of CPI.
Yeah.
So we're going to have...
It's a huge, it's a huge part of what people are spending money on every month, whether it's mortgage or rent.
Yeah.
And like, it's easy to take it for granted as a stable thing. But I think like what you said, when it changes a lot, when prices change a lot, people pay attention.
The people are paying attention. I mean, laser focused. And we know from, we talked about it a lot last week, from Jerome Powell's speech in Jackson Hole. I mean, housing is like that's kind of like the linchpin. I mean, housing and employment, and those are two related as well, clearly.
And yeah, I was to kind of go back to your comments about like the national movements here. Yeah, a lot of the connected to multifamily industry. Yes, there's so much about the market right now that is supply driven and localized, like Sunbelt, but there is a clear dampening effect that's happened for markets throughout the country. It doesn't matter if they got supply or not. There is a general trend that is that's affecting all markets.
Yeah, and it's more to qualify. That we're not things aren't falling off a cliff. This is right now we're so I mean it's a apartment list report that we'll get to in a minute, Matt. But so it's a slight decline, year-over-year decline after 2 years of monumental rent growth.
Yeah.
We're talking, almost 20%, 30% in some markets. So we're coming in off 1% off of that. Yeah. It doesn't even register as a correction or any sort of even reversion. It's just stall. I think it's a true stalling out.
Yeah, and I'll repeat myself in our comments on maybe job markets and then the apartment list report, but the jobs numbers almost. I looked for negative takes on the jobs numbers.
Yeah.
I couldn't find that many, and I'm actually a little bit more bullish on apartment rents than I am on continued job growth, just because the trends are so predetermined for job growth shrinking. But apartment rents, there's a lot more variability and a lot more potential, I think, for growth, especially considering the enormous demand indicated by single family home, new construction, and just the way that people seem to be champing at the bit.
Yeah, I tend to agree. I think things are gonna start moderating, but I think we're gonna see growth in the the 3 to 4.5. I think 4.5% growth over the next couple of years, but we're gonna have some negative growth before that. But I think that it's looking good over the long term, but in the immediate future, it's going to be tough depending on markets.
2 years.
I mean, we're in our portfolio. I mean, we have about I think we're at 5.3% year over year rent growth across our portfolio. So
that's pretty nice.
I mean, we've had some value add plans that we've executed as a part of that. So I mean, but so it's
the upshot to all of this is it ain't 2021 anymore.
It's not. It is not 2021. Yeah. That is for sure. And there's a lot of groups that had 10% rent growth for a couple of years.
And I don't think it's coming back anytime soon.
No. Well, no.
Maybe never again.
No. It never happened.
Yeah.
I mean, we're not going to have those circumstances, and we're going to see. We're not going. Even if we had the same pandemic, we wouldn't do the same things over again.
To assume that this once in a lifetime, once in history event is going to happen again, which maybe some people did, and they put that in their projections when they bought maybe in 2021. They were like, well, this thing is going to keep happening because it's happened for the past.
Yeah, the next opportunity is not going to be, we're going to get 20% rent growth in a year. The next opportunity is we're going to buy at some really great prices and basis and get some, buy some awesome projects, great locations. And then you're going to get slow and steady growth, like has been the case. That's typically the case with real estate. It's usually nice, slow and steady.
Yeah.
You can execute your business plan and hold on to it for a while. You're not just going to be flipping and flipping and flipping. And some people, that's what they are in the business of. But risk equals return. So just got to watch out. All right, let's get to these comments, Matt. You have an opinion on what we've been talking about so far, agree or disagree, let us know, and we'll talk about it. First one, maybe it's a little small. Let's make it a little bit bigger, man. Okay. All right, Jason Worley, about a month ago said, who is the majority? This is on our episode, the Federal Reserve issues new guidance on CRE debt. If you'll remember on an episode, you can check it out, obviously on the YouTube channel. It was talking about how the Federal Reserve laid out some guidance for lenders of CRE debt, of basically how to work out troubled loans if that takes place. And Jason Morley 321 asks, who is the majority of commercial real estate borrowers? Maybe there's an insight as to why they would push this framework based on who it is in the Federal Reserve supports. And then he also made a comment just right after that. Traditionally, frameworks are built to guide decision-making for any such subject matter. They have their guidelines, but no quantitative standards. Perhaps the market conditions being the variable will ground who's approved and not approved through this framework. Matt, what do you think?
I think it's a clear take on what we were discussing. I was thinking like, does someone have a friend in the Fed is that how you're going to get the guidance to have kind of teeth to get but ultimately, when he says it's going to kind of come down to the market, it's going to come down to the banks, and the banks I don't think that the banks, sure, they're not taking it with a grain of salt, this guidance, but the ultimate determinant is going to be, all right, is this going to make money for us? Is this too much risk for us? Kind of,
do we have the bandwidth? It's going to be case by case,
especially in an environment right now where things are so tight and tenuous when it comes to interest rates, and the demand for the volume of loans is a little bit down. The lending standards are a little bit stricter. I think things seem a little bit more constrained, and I don't think that they would be in this constrained environment very happy about loosening standards.
Certainly not. I don't think anyone wants there's no loosening going on, but it's, I guess it's helpful to say, okay, if we are going to work something out, here's at least a starting point.
Yeah. But, and I do, just to call back,
doesn't really mean anything.
And I do remember what was in that. They had these scenarios, and it almost seemed like the worst scenario of the worst shape the borrower was in, the more lenient the lender should be guided to be. And I don't think that that's going to happen necessarily. However, there could be, and the guidance itself could at least influence some decisions to be more lenient to the to CRE borrowers. I don't think it's not going to be a hard and fast rule, but it's at least a gesture. I wonder if now we haven't even seen a breath of the kind of collapse that people are predicting for like the office market. People aren't necessarily predicting that for the multifamily.
More foreclosures I saw trickling over the media.
Okay.
The last week or so in the office world.
And it could, and it still could happen, but we definitely haven't seen like the bulk of it yet, or at least not the apocalypse that was being described. If that does happen, I wonder if we get guidance that has like money attached to it or some kind of government support
and I think that's like the point that I think Jason is making here is they don't want to give those specifics. They don't want to give those metrics, because then that really can I think pigeonhole some decision making. And so I think just giving those kind of loose examples, and it's like, this is your example, come close to one of these.
Yeah.
Here's a way to think about it. Okay, let's move on to the next comment from Lee Garried on YouTube. I think this is from the video, how much farther will apartment rents cool? Well, Matt, it's a good time to talk about this last episode. Obviously, they have cooled some more. He says, I think there is a supply-demand demographic imbalance. The strongest supply is in Class A, but the largest income growth has been in the lower-income households. However, CPI rent growth is measured across all renters. Might be more underlying weakness in Class A. And then we responded, one fact, I think this is me, Matt, I don't know. Maybe it was you. One fact I would point out that this has led to continued performance in Class A is the relative affordability of rents, even for high and relative to the cost of a mortgage. Basically making the point that while there may not be as much income growth in Class A, there's a lot of folks that have very high incomes, but maybe don't have the savings for a mortgage are going to be renting for longer. Commenter came back, Lee Garried, said, I don't know how many renters are comparing buying versus renting or comparing rental options. I think this is ultimately a supply story, especially in Class A. And I don't disagree with him as saying that it's a supply story. There's just so much Class A that's coming online. There's just going to be weakness. I think that that is certainly a factor. But I also believe that there is a lot of demand in that Class A. So is it a wash? So just not a lot of growth, or is the demand a little bit more than all the supply, or is the supply? You mentioned this earlier. The supply will be absorbed. Just how quickly? Yeah. We're not seeing things fall off, a cliff by any means. Not yet. There's still a lot of supply that is still to come online though. Too. So I don't think anyone is disagreeing. There's going to be a period of softness, in some select markets, especially for a period of time.
I think he's right that that the force of the new of the factor of new supply coming online, that's a bigger factor for Class A rents than demand. However, and I also kind of agree to a point about the high cost of single family homes and that being a maybe negligible factor in apartment demand. However, it is a sign of higher housing demand in general. And that's what it's kind of referencing, we've got this high housing demand in general. And whether or not the demand for Class A apartments is going to be due to people making the discrete decision not to buy, but to rent, or as a part of just a rising tide lifts all boats. It redounds these high housing prices in a way redound to the benefit of apartment operators and people that are counting on rent growth to bring returns on their investment. And also when it comes to affordability versus rents, your comment, or maybe it was our comment, I forget, but I always had a little bit of an issue when people are comparing the affordability of housing or single family homes with rents. I'm going to go for a square footage basis or something. It's just not apples to apples.
Well, people aren't actively, and I think you guys are both correct. Yeah, people aren't actively saying, oh, I'm looking at the same time, I'm looking at rentals, but I'm also looking at buying a home. You've made that decision, but there are some people who are, so we're talking about two different decisions, not like which house I'm going to buy or which apartment to rent, but the buy or rent decision. There are a lot of people that are having that, they're asking themselves that question. And sometimes I come to the conclusion really quickly, but there's a desire there, just looking at demographics. And there's a lot of folks that are mid 30s that would historically be buying a home that haven't yet. Yeah. And they undoubtedly have some people in their social circle that probably have bought a home and they've at least thought about it. And again, maybe they've decided no.
Well, and what I also want to say is, regardless of how true the affordability thing is, are rents or mortgages, the fact is housing price, the cost to buy a house has risen so much quicker, faster, greater than rents. So, on an absolute level, I don't know how they measure it at square footage or not. But if we're talking about increases, man, it got way more expensive to buy a house. It got more expensive to rent, but we're way more.
We're talking about a lot of people that are on the margins where they were like, I could just barely, I can't afford it, but it's tight. Well, okay, if you were on that cusp, I mean, there's a lot of people who are like, okay, now I can probably afford to buy a home because, the mortgage is only going to be, $1,000 or $1,200 versus, the rent's going to be $1,300 or $1,400. So makes sense. I'm going to save, even though there's other costs associated with buying a home, but at least that's the sticker, you're comparing the sticker price at least is comparable. Now they're looking at it and they're like, okay, the rent still is going to be $1,500. The rent's gone up, but now the mortgage is going to be $2,200 or $2,500, and plus, the down payment's going to be even more. And so it's if you were on the fence, I could have, and actually maybe we'll save money on a monthly basis. Now it's not the case. I think a lot of people are saying, I have to wait now.
Yeah.
It's not like even it's just right now it just doesn't work. I mean, it's the same reason. It's basically the same reason why we haven't bought anything for a while on, the multifamily side. It's not because we don't want to. It's because, we have certain metrics we need to hit, and we know what a good we believe we know what a good deal looks like in a variety of market conditions, and have adjusted what we're looking for, and nothing works. It doesn't make sense, and so buyers of homes they're saying the same thing.
Yeah,
it doesn't make sense. But they still. This is what's great about housing, and we're in this space, is they still need a place to live.
Yeah.
And so it's not discretionary at all, and so that's why it's helping. It would be a lot. Maybe this is a better way to say it. It's not that Class A is going to do really well because of that dynamic, but it's not going to do nearly as bad as it could have. In a relative, I think people will be surprised of how much is absorbed.
Yeah.
Relative to the scenario of where the demand wasn't there either, and you had supply. So,
and it is worth noting, this is it was about a month. This comment's about a month old or a couple weeks old, maybe. That this Marcus and Millichap does show a relative increase in Class B and C compared to Class A. So
yeah, well, I think he was right. That's what he was. That more or less what he was saying.
There you go.
Okay, Matt, let's do another one here. This is on a little segment from an earlier episode a couple weeks ago on WeWork's closure to bankruptcy, but flex office space still works. Talking about struggling offices, especially as co-working spaces, and specifically WeWork and all the troubles that they're having. Just want to make sure we're showing that. From Cyberla. Great discussion. My colleague was telling me about this the other day on one of our few days in the office. That's great. Get into the office. Love to see that. We're here just about every day having fun. Why don't we, man, I'm sorry.
Yeah.
This is important.
Yeah.
We don't, why don't we should at least have a symbolic water cooler. Like, it doesn't even have to have, true. I would like to have water in it. Okay. This is something we can, this is a Amazon thing that can be here in a day or two. We'll have to get the service. All right. We'll figure it out. Anyway.
Hinkley Springs.
I do not have ADD.
No, that was that was a good aside.
Note, this is like the voice menu that I can memorialize on the Gray Report. But talking about working from home, working in the office, we work. Matt, I know this is you.
Yeah, because that's a read more. It's too wordy.
Not knowing that. I just know your style. Thanks. In the past 2 to 3 years, the dramatic rise and persistence of remote work has coincided. Yeah,
that's my favorite phrase.
Has coincided with the biggest change in apartment rents in recorded history. And do you want to read your
comment? Sure. Yeah, sure. And while the apartment market is stabilizing with some ripple effects in the wake of the extreme rent growth of 21 and 22, the longer terms of office leases and extended negotiations between remote work and back to office advocates have left the office market in a much more uncertain position compared to apartments. In the apartment industry, one source of renter demand comes from people who are moving from one city to another, or they're in a transition period while they're looking to buy a home. And I'm sure that companies are in a similar transition period. So short-term flex office space seems like a natural fit for employers in this environment where it's so difficult to predict longer-term workplace norms. Basically, that article that we were covering was talking about how WeWork is failing, but then there was another company, there was another flex office space company that was doing okay.
Yeah.
Because, so it, and then his response, he says, great response, which I loved. Currently, I work at a very prestigious office space in DTLA, in downtown LA, a few days a week. Oftentimes, our massive floor is virtually empty, and I'm sure that we have multiple virtually empty floors with most people happy to work from home. LOL. Definitely interested in the multifamily market, being as an insider myself. Looking forward to your insightful videos. Thank you, Cyber LA. I think that it is definitely a sign of the times. In the Indianapolis, and maybe LA's in there up there too, but Indianapolis is among the most empty of the downtowns in terms of office demand. Maybe third lease.
Yeah. It's interesting. Anecdotally, when I go downtown, where we kind of where we work just on the edge of downtown. I mean, it's very busy. There's a lot of stuff happening. But then on a lot of those reports that are coming out, it's like one of the least recovered downtowns.
Yeah.
Like in the nation.
I don't get it, because I remember when we had our office closer to downtown and it was quite empty. It was delightful to work work there and walk around during like the lunch break. And everything.
We signed a lease in 20, like COVID had been going on for 6 months, and we were like, we had been looking for office space like immediately before COVID, and then decided not to get any office space because we were like, working from home. Got way too sick of working from home. Need to be around people, and we're like, that's fine. And so we were right downtown, and like right downtown, and it was great. No one was there, being able to walk around.
Yeah, and I don't know where downtowns are going to come, whether it'll be like this. We had that McKinsey report that called for a greater mix of retail attractions and multifamily and office, and so that you can kind of thrive in this ideal,
So there's a city, there's people, there's businesses.
Well, there's
shops,
like local
markets,
local diversity, I guess. But I don't know if that's ever going to come to pass. If things are going to look a lot different. But there is some appeal to working downtown. There is like a vibrancy, and just like the physical environment is cool and exciting. And it's a lot different than going to in a suburban office park and coming, and just not kind of being in that environment. It's just a little less boring. It's more about the space around you.
Even some of those suburban office parks, the newer ones at least, that have had some like money put into them are nice.
Yeah.
That they've like, added restaurants and cafes, or at least amenities. The office that's going to succeed is going to be, very highly amenitized and really nice. Going to almost be like apartments. Not really, but
no, I agree. Yeah, the high end.
I mean that's why we chose where we are. Because we've got we got a climbing gym.
Yeah, I know of. There was I was talking to someone else who owned a business that was thinking very hard about. He really wanted everyone to get back in the office, and he wasn't going to force them, but he was going to spend money on a very expensive office as this attractor to get people back. And I think that's probably what a lot of companies are thinking. If they're going to get them back, make it nice.
Yeah. I mean, if you're going to, and this isn't even a COVID thing. This is you're going to spend a lot of time here. Yeah. And so, it's not necessarily you need to spend a lot of money, but you want it to be a place where you want to spend time in. And that's everybody. And you want people to, feel comfortable. And that's why we tried to do. And if didn't know and couldn't figure out, we're in we don't say it enough, I guess, we're at the Great Capital headquarters where we have a podcast studio. And we've got a glass studio here, but you can see into our office. Not as many people here today, but it's not because they're working from home, because we've got multiple groups out on site, walking different properties. But we've got a big open area here to, lounge out, hang out in. Got our shuffleboard, which may be turned into a craps table. There's a lot of rumors.
Ooh.
Room for activities.
And I think that there's a lot of room in offices throughout the country. And I wonder if are they going to be willing to accept kind of a lower density, in exchange for just getting a renter in, or I don't know.
I think so. I think so. I think you're going to continue to see the other price per square foot. Go down and down and down. All right, Matt, you want to hop into this
totally
real page piece? U.S. job growth exceeds expectations in August, but again, this is this narrative, Matt. No landing. Smooth landing. The gear seems to be down. We're on a glide path perhaps, but what's
I use the boat metaphor later. So
what metaphor?
The boat metaphor.
A boat. Oh,
yeah, because we always got to go nautical.
Good. Okay. Very good. Said U.S. job growth exceeds expectations in August.
So the jobs numbers came in last week, lower than the previous month, but
the good news for people who love bad news, right?
I know, and in this weird world where high jobs numbers means you got to get worried about interest rates, then that is good news, and that I think that it really, given the tenuous position between inflation and recession, there is definitely more than one way to read these employment trends. At first, I was going to use this real page headline to make to mark the optimistic end of the spectrum. They're clearly spinning it, exceeds expectations. It's good news. Don't worry about it. But I thought that was like far too rosy of a picture, but RealPage's take is not far off from the mean. Most sources saw these slightly weaker jobs gains as either a sign that the Fed's rate hikes are sinking in and effectively curbing inflation, or the softer jobs numbers are kind of excusable since employment is still above pre-pandemic average. Or maybe they kind of, which is what this article does, kind of gloss over some of the implications about these jobs numbers to emphasize the resilience of the labor market currently. I don't think we're headed towards a recession. And even if there's a relative downturn, I don't think that we're headed there yet, although I think it's starting to happen. What does make me a little worried is that if we believe that the Fed is responsible for cooling employment, is this employment slowdown has taken a long time to build. We have been losing jobs actually for a number of months consistently. There's been a couple spikes up, and you can see that in the graph that they have in the actual RealPage article. I don't think that these gradually shrinking jobs numbers are going to turn around on a dime, even if the Fed decides to start cutting rates, which they have not. It's a big boat, right? And yeah, you can see that the chart here is since, really like 2 years ago, they've been consistently going down. The monthly change in non-farm payroll employment, it used to be around 600,000, 500,000 in 2021, and now it's around 200,000 in 2023. They have since revised the June and July numbers to be lower than they were, and the implication in at least to this RealPage article that I'm reading between the lines in is that maybe the August jobs numbers could be revised too. This trend of slowly decreasing jobs numbers seems pretty persuasive that we are cooling off. I've read so many articles that were like, we're still above pre-pandemic averages, jobs markets, labor shortages, wage growth, where we're doing really well. And I think that there's definitely like a partisan element to it, but that's beside the point.
Yeah. I had someone, and I think someone told me, or made a point to me, this was like a couple months ago, but they were like basically saying that, the Biden administration, and I'm not a fan of the Biden administration, but they were like, the Biden administration has only created like, 200,000 jobs or something. And I was like, well, I don't really give any president really much credit.
Yeah,
for good or bad. I mean, sometimes there's occasionally something that happens, but I'm like, it's like, again, in this piece, I mean, the average is 400,000 a month.
Yeah.
So I'm like, well, even if it's like a fraction of like what it truly was, it's not useful. It's not a useful conversation. It has nothing to do with Joe Biden.
I don't know what I don't know what the statistic, but it certainly seemed like, and I'm going to have to chase this down. I don't know what the numbers for the Democrats are, but Republicans, their view of the economy is about 4 times worse when there's a Democrat. So if maybe 25, there is a partisan element to how you think it's like presidential approval rating.
And the Democrats are going to be talking about how great the economy is through, election season. Yeah. I mean, and so, we are in the presidential election cycle. And so the, economic warfare, I mean, it's at the top of the list of, conversations around the dinner table.
And what I noticed, I said that I use this to mark the RealPage as an optimistic take. I was looking for a more pessimistic take. I went to Fox News, Fox Business, and they had kind of similar language. They were talking about they were also saying like, actually, the jobs numbers are a little bad, but they're not too bad. They were not saying this is an indictment of the Biden economy with consistently shrinking numbers.
And again, the reason why we're talking about this, but it's related to interest rates and what the Fed's going to do. And again, my takeaway, not necessarily the media, everyone else's takeaway, but my takeaway last week was that as long as we kind of stay on the general trajectory that we are on, we're not going to raise rates. If we see a big spike that we don't expect, like we're going to raise rates. And so this is just one more data point of, okay, we're within the range of, again, like we're on like the glide path for whatever type of landing we want to describe it, or I don't know, maybe we get the boating analogy.
And that's the thing, it's like a big boat. We've got Jerome Powell in the tugboat turning things around, but that's not a fast tugboat. It's turnaround. And I think that we could easily overshoot where he's headed for, in terms of like cooling off employment, we could be below pre-pandemic averages before things start turning into positive. I don't think it's a long-term thing because it's so clearly seemingly connected to the interest rates, but this interest rates, it's not a snap your fingers and things get better. Even if the interest rates go down, even if interest rates immediately go from wherever they are now to 1 or 0 immediately, employment's going to take some time to pick up. Now, what's going to happen is rates are going to be if rates go down, they're going to be gradual, and employment's going to be gradual. So we may be a year or so off of like an employment stabilization.
Yeah, I don't think if nothing cracks, I can see rates staying where they are for the next 12 months, and then it's going to be 25 basis points down. It's going to be a little because they're going to be nervous to do it, and so it'll just be a little tick down unless. Again, we've got all these loan maturities due coming in October. This is the thing. Again, the narrative changes all the time. And unless an event, that's the thing. It's we're on this path right now, unless these other things happen. And again, the one thing that I'm keeping my eye out on, and it's not necessarily it's going to be really bad. It's just something that, again, you have to have on the board.
Yeah.
We've got all of this debt, real estate, corporate, all this debt that's coming due.
Yeah.
In the fourth quarter of this year and then through next year. Matt, you've got an update to our loan maturities report that's coming out soon. I don't know if it's coming out soon, so maybe we'll talk about it on a future episode. But again, October, which is next month, is when it begins, and that's just when it begins. We are in the eye of the storm right now. Things are really quiet. We knew they'd be quiet because the expirations were supposed to be so low right now, and then. The piece that I don't know is the derivative, its secondary and tertiary effects from these loan expirations that we know are coming due.
Yeah.
So it's we know surface, very superficially, okay, we can see distress from borrowers, potential foreclosures, handing keys back from the bank, and that can affect prices. And so, okay, that's one layer that we're primarily concerned about from a standpoint of we want to buy some good deals and obviously turbulence in the market. But then there's the derivative, literal derivative effects are what we all, witnessed happen in the last financial crisis.
Yeah. Is
that there's all of these, again, little derivative instruments that are based on the housing market because the housing market seems to be so stable. And we were making the same assumptions a couple of years ago, like we were in 2005, 2000, these, early 2000s that led up to the 2008 financial crisis, is that, the housing market is so strong, especially, again, a couple years ago, we haven't built enough houses. The fundamentals make a ton of sense. Yep. The fundamentals still make a ton of sense. And so it led to borrowers taking on what they thought was very little risk and ended up being a lot of risk.
Yeah.
We had the bank failures. Exactly what happened there.
Yeah.
Not only about buying treasuries, they're buying mortgage-backed securities. Sound familiar? Because they saw them as almost no risk. No one thought interest rates were going to be going up at all. And everyone knew that the housing market was going to be just fine.
Yeah.
And all of real estate, including office. So when you see that level of confidence, there are all these synthetic and derivative instruments, that are based on these bundled securities. Because, when when a bank makes a loan or a lender makes a loan on a property, they're bundling those loans together, putting them in a package, and selling them off to another investor. They're securitizing it. There's a whole financial world of derivative products that are layered upon these underlying assets. And that's a much larger market.
We've taken a peek just looking at the loan report from some of these data sources where you see all of these bundles of it's like one of 94 assets are part of this super loan, and some of these super loans aren't doing too well. No. And we saw we put it in a database and we looked for some of the properties that might be in trouble, and they're just a slice of these loans. I don't know if a bad apple is going to spoil a bunch, but I do think that this is an interesting, ancillary effect that the Fed's not part of the Fed's purview necessarily to fix the problems that they create in the debt market. They're talking about employment and inflation, but I think that they've got to, that there's got to be some reaction. They're mentioning it in the minutes of their meetings, so they're aware of it. And I do wonder if there's going to be a reaction from the Fed a reaction to the kind of debt crisis that they're creating.
That's again the black swan that could be out there, and it may all be fine and work itself out.
Yeah.
Again, because the economy is stronger than anyone could think. People do have a lot of cash on the sidelines. People are relatively well capitalized, but that is floating out. It's certainly floating.
What I wonder is the labor market slow cooling? Is that is that the kind of slow realization that we're going to see? It maybe not be a crisis, but it's just this continuing tightening of belts and things like that.
Yeah, it's a good point, Matt. I think we'd be amiss if we didn't just watch this classic clip from the Big Short, because if you don't know what we're talking about, again, it's the same exact thing. And I remember, when these CDOs and these big piles of mortgage-backed securities that are packaged up. We started doing all, not like us, but like the industry started doing all these things again. And so let's just hear it.
So here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack.
10 million because this hand is meant to represent a single mortgage bond. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So my odds are good. I'm on a winning streak. Everybody in this place wants to get in.
Everybody's confident in the housing market. Exactly what's been going on.
This is a classic error. In basketball,
exactly what happened again.
Fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one.
Interest rates will be low forever.
Whatever's happening
as it keeps going.
It's going to continue to happen into the future. During the real estate boom, markets were going up and up.
Office
people
even
thought they would never go down.
Yeah. So people who are watching
B-class office is an opportunity.
Side bet.
Yeah.
Now this is the first.
There's a side bet.
I love Selena Gomez. Bet you 50 million she wins, and I'll give you 3-1 odds.
3-1 odds. Okay, I'll take that bet.
Now, somebody else.
The Sun Belt can never fail.
That's right.
Outcome
Phoenix.
of their bet.
50 million she wins.
That will lead.
Austin's the native tech hub of the world.
I bet you 200 million.
But Mad Libs
Glasses wins that bet.
She probably will win. So I want a great payoff.
About 21.
Deal.
And this will go on and on, more and more synthetic.
San Francisco
We can
always here as a rent.
$10 million investment.
I mean, seriously.
Yeah.
You okay? No.
Okay, well,
Did they show her losing the hand? There you go. There you go.
So I'm going to need.
Oh, a metaphor. Oh,
he's talking to this CDO man.
He's going to leave because he knows you gotta get out.
But let's do this.
Might as well.
That's editing.
Yeah. So appreciate everyone indulging us. I mean, the movie never gets old. I mean, it's just it's such a classic. But that all happened. That's all been happening again. Okay.
Yeah.
And so
my wife was actually telling me about this.
Oh,
She's
yeah.
like, isn't it? Doesn't it seem like relevant? Yeah, it really is.
And so in a similar way, I mean, again, we can have good fundamentals. We can have demand for housing, but we can have a financial crisis.
Yeah.
And again, First Republic Bank, they were making risky bets.
Mm-hmm.
They were buying treasures.
I know.
They were buying and so
Yeah.
to buy real estate, I mean, again, like the fundamentals are solid. We haven't built enough housing. People need a place to live.
Mm-hmm.
People are going to be renting for longer. I mean, like the all stuff that is true and is still happening, but that doesn't mean you can't just continue to bet. And if you didn't believe that interest rates could go to where they have been, which no one had in their model.
Yeah.
Whoops, it went way outside of the parameter. We never modeled that. We never thought it was possible. Yeah. And so all of this begins next month.
Mm-hmm.
So, and again, that's not going to be positive economic pressure. And so you could see rates coming down much faster,
Mm-hmm.
much sooner than people think if we get some major turbulence. From that, but it doesn't mean it's going to all happen in October. It's just that's when it should begin.
That's a good point. And yeah, it'll be shaky, and and with high potential for some kind of distress through 2024.
Yeah. All right, Matt, you ready to hop into this?
Yes.
Just blockbuster apartment list.
So, like I said,
did I just move from the spot you wanted to start it?
Oh no, it's fine.
Matt, blockbuster report. Matt,
totally.
In.
So this is Apartment List's monthly national rent report. This is a report from last week. If it was published one day earlier, it definitely would have been kind of like a headline for last week's episode of the Gray Report. But suffice to say, it's really impacted my thinking for this week, and I've kind of been cogitating on it through the whole weekend. Apartment List.
You've been what?
Cogitating, meditating.
Oh, okay.
Thinking on it. Apartment List recorded negative year-over-year and negative month-over-month rent growth in this report. There's really kind of no wriggling out of this one. Both long-term and short-term rent growth metrics are decreasing, not simply decelerating. And the seasonal rent trends that supported rent growth in the spring and summer are now kind of reversing. And we're seeing, as we are past peak renting season and heading into the fall and winter when leasing traffic and rent growth typically slows down. I think notably, as Apartment List lays out here, the slowdown is about 1 month early, with August typically in the pre-pandemic average. August usually has modest positive monthly rent growth, but this year we've got modest negative rent growth. Not a huge swing, but worth noting. And it supports the idea that the positive rent growth that we saw earlier in the summer was kind of tamped down. And in the wake of this new supply and what could arguably be seen as a technical mean reversion in the wake of, I'll repeat it, the strongest rent growth in recorded history. Rents are cooling in most of the markets that Apartment List tracks. A full 72 of the 100 markets they track have negative year over year, and 53 out of the 100 have negative month over month. So it's not just a couple of big markets pulling the market down. It is a little bit more widespread. And if you want to scroll down to the map that they have, it looks like it's almost like this organic spreading pattern where cooling rents are moving slowly toward the Midwest from the Southeast.
This one?
Yeah. Now, I did mention before, it does seem like, even though supply is a localized thing and rent growth has been highly impacted by supply this year, these markets in the Midwest that didn't see the huge supply increases, they may still be affected by national trends. And it's hard to see a situation in which it escapes the larger rent growth environment that's happening throughout the country.
Fastest year-over-year rent declines in Oakland, California. Again,
interesting.
That's right outside of San Francisco.
I am thinking that most apartment investors, asset managers, multifamily professionals, they're really kind of well aware that multifamily performance has softened in 2022 and 2023, but I am sure, and this is kind of the upshot to my thinking really here.
Yeah.
I'm sure that there's a delusional hope in the back of some people's minds that rent growth is going to come back above 3 or 4%, that things could return to what they remember in 2021. And
that rent growth, going back to 3 and 4 or 20?
Go above 3 and 4 towards 20.
Yeah. Because there's a big difference between I guess call it 3 to under 10.
Yeah.
Yeah.
Okay.
10 smoke. 10 is like smoking, but you can do more. Or if we're talking organic.
So there's this delusional hope now that still may be lingering.
Yeah.
That's like, we could maybe get these magical 10, double digit rent growth. I think that reports like this are a strong corrective to that lingering mindset. The multifamily market is not returning to the way it was 2 years ago. Get that out of your mind.
Yeah.
It's over.
Yeah. And one reason, Matt, that I haven't seen discussed as much is the effect of rent optimization out of technology.
Oh, good.
And moving the market much quicker than it has in past cycles. This is the first real cycle of negative rent growth. I mean, I guess a little bit in 2020. I don't know if
that is a really good point.
There's a lot more properties, a lot more markets.
Kind of nationalizing. I wonder, that would be really interesting to know quicker. If these rent growth platforms now, my guess is that they don't, but a part of me thinks maybe that rent growth software in Indianapolis could be reacting to things that happen in Austin.
No.
Okay, good, good. Oh, but like,
not like, yes, but not like
sure.
very, but not, it doesn't have anything to do with the soft. it's you're going to be still using your comps.
Yeah.
But then but I'm saying it does in a sense that it's like, if you kind of keep moving your furthest comp away, the furthest comp away, and you draw a connection, like maybe
okay, there we go.
Like
that's right.
many degrees of separation.
Yeah. What I wonder though, it does seem really, really reasonable to think that the software is turning rents in the same way across a country, and there's going to be more of a lockstep.
To me, it's not as much as like everything's talking to each other, as in just that it's reacting quicker.
Okay.
And that instead of asset managers, let's say if they're very proactive, maybe you're looking at your rents on like a once a week basis. That would be considered like pretty proactive, because to do it on like a daily basis individually, I mean, people do and have done, but that's hard to do because like what did you have to like test it out? Like we got within like 2 where it's like, oh, we'll change it again. Like you need more data. And it is possible, I guess, but again, an active would be like on once a week. Monthly is still much more active than normal. Quarterly is what a lot of people have done in the past, and mom and pops they maybe are looking at their rents once a year. So we're moving further and further away as we've institutionalized the industry and we've added technology. Just think about the difference between adjusting rates on a yearly basis versus a quarterly, monthly, weekly, daily, and whether it's LRO, any of these rent optimization systems where they are looking at your rents, your future availability. They're looking at the market, your like immediate market of like, what is your competition charging? What's their occupancy? What are they charging today? How much demand is there in the market? And then adjusting your rents accordingly on a daily basis. So like if there are no 1 bedrooms in the market and you've got the only 1 bedroom out there and someone else just leased a 1 bedroom for, 15%, above what you were charging, it may say, okay, we're going to bump that 1 bedroom price. Conversely, if everyone is having to decrease their rents because the demand isn't there, or there's more supply, a new apartment comes online and they cut their rents because they've got a loan coming due and they just need to lease the place up, and so you get 100 units of new supply at like lower rent than your property. That's going to tell you like you're going to have to bring the rents down, and the whole market reacts quicker as opposed to, oh, next quarter when we're looking at the rents, hey, we should really do something here. Or next year we're like, hey, we've had some problems, now let's readjust things. And so it's I think it's a good thing. The market can react much quicker, but it's going to feed into where like we may without this type of software, maybe rents would have stayed higher and we would have just seen occupancy drop. The result of this is you're going to, it's what it's optimizing for. It's typically optimizing for, for revenue. And, but also, that's going to probably be shooting for like 95% occupancy and max revenue rather than 100% and lower revenue.
Interesting.
So,
so this apartment list report is one of the first to show this kind of negative month over month and negative year over year, but I don't think it's going to be the last. And I think to support my point, there is a LinkedIn post from Jay Parsons that's probably going to turn into a real page report. Now, to summarize the apartment list report, they have
people can follow you, man, on LinkedIn too, I guess.
Right, if they like. Now, just to summarize, the apartment list report had negative year over year, negative month over month report. I don't have the specific numbers, but they're just barely negative. For RealPage, they have year over year rent growth at 0.28 and month over month rent growth at negative 0.06. That is, I think that's well in line with a trend, and you can see that trend is continuing of how rent growth on a month over month basis is continually decreasing from its peak.
And again, going back to CPI, I mean, this means that we're going to have another period of, declining CPI prints, or at least in the housing section of CPI for like the next year. So we know like the housing component of CPI for the next year is going to be in the lower range. Like like in May and June, we'll see a little like a bump up. like a moderate little like a little bump, next or plus or minus a month or two.
Yeah.
In 2024.
I wonder if so.
What year it is, right?
So Jay Parsons.
Think about what year we're in.
Yeah, I know. Jay Parsons mentions that we may see negative rent growth in the CPI, well into 2024, if possible. I wonder if just the kind of smoothing effect of the CPI will keep it in positive territory. I think either way, it's going to come well off.
Yeah. I don't know if we'll see declines, but it's not going to be elevated.
Yeah,
it's not going to be like a driving force of inflation, even if rents recover and start moving up again.
Yeah,
which is easily most likely would happen because rents typically don't decline for that long period.
Yeah,
but we're hitting the slow season early.
So yeah, both Apartment List and Jay Parsons, they talk about, a bunch of supplies come on, a vacancy is up above pre-pandemic averages as Apartment List says. And it's been gradually, so vacancy, along with declining rents, vacancy has been increasing for 22 consecutive, this is the Apartment List report, vacancy increasing for 22 consecutive months since its low point of 3.9% in October of 2021. So we've already passed, and this is kind of and we've referenced this before earlier and just few minutes ago, we've already passed through to the other side of this abnormally long 2-year super cycle of rent growth, and we're kind of in this downward ripple. But if we're talking long term, the trends for rent growth are very different than the labor market trends that we discussed earlier. The last 2 years for the labor market, you see consistent, there's a couple months that will spike up, but very consistently downward trend.
Yeah.
For rent growth, it goes up and down, and you can see that things are way different and totally not predetermined in the way that the labor market seems to be. And so this is just looking at the rent growth trend line itself and not thinking about the larger factors of demographic shifts and supply and all these kind of all these other external factors. It's easy to see some more hope, I think, when it comes to rent growth compared to really the labor market, which may continue to cool. But that's just reading kind of the technical, just like the pattern itself. And when you look at the factors, when it, population growth, household growth, the housing demand that is shown by, strong single family home buyers, there's a lot of reasons to be optimistic, even though, and we are going to be headed into a winter of negative rent growth. And that's going to be something that people should get used to, even though it may be hard to get used to it after years where there wasn't any negative rent growth in the winter.
Yeah, and when residents are armed with that fact, because everyone's still thinking, rent's high, and they're just getting over like the rent increases. Once all of a sudden that's in the kind of the mainstream narrative of like, rents have gone down. It's going to be many more people will be pushing back and really asking for a discount. Like, I heard rents are down. You can't be charging.
Oh, man.
It could be a little bit of a.
So when it's high and when it's low,
everyone. No one at no point ever is someone like, oh great, the rent's going up.
I should not be paying more.
Yeah. Are you sure? Is that it? Are you sure?
That's right.
Only $25.
Yeah.
I mean,
you guys are doing such a great job. I put a little extra there for you this month.
The property management arm of Great Capital, Katrina Green, director of property management at Great Residential, just launched a podcast this week called The Complex. I've listened to half of it. It's really interesting, and it's very it's covering different topics. It's much more on the operations, but like if you're a multifamily investor, and be like, it's going to make you such a better investor of hearing, because Katrina's, I think, got 26 years of experience on different angles of property management, property operations, been on the vendor side. Yeah. And the guests that she's bringing on are also people in the industry. They've just seen so much, and the reality of the way, sometimes the perception of what it is, and then the actual what it takes to do, and the reality and the challenges are all so interesting. You put a business plan together on a spreadsheet, and
I know that's what.
It's like there's all these, there's people and systems and all of this complex, patchwork to make it all happen. And it's not just a model in Microsoft Excel.
Yeah, it makes so many things that we talk about every week seem like romantic abstractions when she is just the rubber hits the road. We talk about rent growth. Well, the actual physical discussions that she has with with residents, that's what actually that's driving the rent growth.
Yeah. And that's part of the reason why we started doing property management is so we can not just out here on a podcast in an ivory tower in the little glass recording studio talking about with growth and how it affects investors and renters, but actually being directly involved in those conversations with residents, people who are living in the communities, what they're different, we've got some super high end, class A, luxury apartments. We have some, more of your kind of B class, C plus class that are kind of like, middle low income properties as well. And so a lot of different types of conversations. But it's, there's real people, a lot of moving parts, and it can be messy and complicated, especially when you have a large organization, you're managing a lot of people, a lot of properties, a lot of units, thousands of residents. And so it's a really, really good podcast to check out. But seeing what it's like on a day where we got to this, is seeing the really what's going on a day to day.
It is
on the ground.
It is incredibly important, I think, to understand this level, and it's a disservice to only look at it in terms of like larger abstractions and trends, and not really have a curious enough mind to know what these ideas are and how they translate into action. Because that's how you tell if it's good or not.
Yeah.
If it's not translating into good enough action.
Yeah. Well, so Matt, Marcus Millichap put out this report. It's really interesting.
Yeah. So it's just a kind of nice, concise review of the apartment market from Marcus and Millichap, and it's got cap rates and capital markets outlined alongside rent growth and apartment fundamentals. And what I really appreciate about this report is its focus on increasing operating expenses, really pushing it to a headline issue for their quarterly report for the apartment market. Running an apartment building is getting more expensive, and it's worth repeating how. One of the expenses is insurance. I know it's utilities and even like labor costs. There are just a lot of different elements of expenses that, even though headline inflation is down, these expenses are being incurred this year because it's kind of a backward looking from the past and the way that the budgets are made and contracts are renegotiated. Their costs have gone up, and that kind of passes through, whether it's a landscaper or whatever. And so I think that's what a lot of apartment
the insurance
are dealing with.
The insurance piece is the one thing that's really hitting folks upside the head in a way where it just, there's nothing really you can do about it. But there's very little you can do about it.
Yeah. And that bar graph they have of expenses outpacing rent growth. The average expenses in 2022, the average effective rent far outpaced expenses. But in 2023, the average effective rent growth was about half the average expense.
Yeah, I'm getting flashbacks.
Growth.
It's something we are still dealing with. But Matt, you'll remember. We basically in early of this year in 23 and in the first quarter, first half of the first quarter, we had to completely relook at our entire budgets and realign them and bring them into reality, and that meant changing the way that we operated in some ways to like make things work. But it was very challenging. But we're in the Midwest, where they're calling out for Midwest and Sunbelt markets enjoy lower premiums, specifically on insurance. But so like here's it's not always going to be like this. But like for right now in the Midwest, and why our portfolio has been in a really really good position, and why we're still really bullish on the Midwest, we're not seeing the increase. We're not seeing the relative increase in insurance premiums that other states are seeing. Has insurance gone up over the last couple of years? Oh yeah, for sure. Yeah, but it's not like 10xing like I'm seeing in some other states in the Sun Belt that you get hurricanes, some of these natural disasters. In Indiana, it's kind of boring. Like we have tornado drills every once in a while, but like it's not that. It's a tornado is not. Every once in a while one happens. It's not that big of a deal.
But even though we're quote unquote spared from the high insurance premium, the fact that we're seeing a huge increase anyways is
still not easy. We're just not getting the extra hit.
Yeah.
In Indiana, we're a property tax friendly state. We're not getting like reassessed all across the board. We haven't had reassessments because we also do some strategies to making sure that the probability of getting assessed is as small as possible. So I mean, we actually don't get assessed, but especially when we're buying in Indiana. But also, so we're expenses have gone up, but they're not as up as other markets. But also our rent growth is still positive.
Yeah.
I mean, Indianapolis is like 1% according to the apartment list. But I mean, like our portfolio, we're over 5% year-over-year rent growth. That's compared to most other markets that have seen negative rent growth and have been clobbered by higher expenses, insurance costs. Yeah. And Matt, they bought at lower cap rates.
Yeah.
So their valuations, again, you've got the numerator, which is the net operating income. And then you've got your denominator, your cap rate. Both of those have gone in the opposite directions for a lot of the consensus investment markets that the folks, in New York City or LA or wherever are like, oh, the Sun Belt sounds like a great place to invest. Yeah, of course it is. Doesn't mean you can just pay whatever price.
Yeah.
In the Midwest, we've been buying at reasonable prices, getting better growth, better NOI growth, and it's a reasonable place to do business as well.
Expenses there may not be as big of a surprise or for increased expenses as the year goes on and into 2024 because of lower inflation, but lower rent growth it's not going to leave a lot of hope for people that think that they can wait out the kind of whatever loan trouble they've been in.
And it's not like interest rates are higher. Yeah. They're not lower.
And this is going to be the real test. We're alluding to this loan maturity report that I'm working on and updating. But October, these maturities are coming on. October, November, December, they're going to be working it out and they're going to be waiting. One of the factors is, are we going to have rent growth that gets us out of this? Not in the near term.
You can't turn a whole rent roll.
Yeah.
It takes time.
Yeah.
I mean, you're not even going to be you're renewing half, new leases on the other half. Your renewals aren't as much as your new leases. You're struggling to get new leases. I mean, and then that's where you look at some of these models. People put a deal together, and it's like, do you not know that how the business works? They're so disconnected. Yeah. And again, it's like they read a book, they attended a course, they downloaded a model.
They sold it.
Plugged in some numbers.
They were great salesmen to sell their numbers. People believe them. They saw the
real estate's exciting. That's what's frustrating because, it's like it's such a good business. It's such a great asset class. I just wish that people didn't
have to be any better than it already is.
Yeah, exactly. Yeah. It's just it's good enough. We don't need to you don't need to sugarcoat it or make it and be real. Like it's not always easy.
And we mentioned this. We're not going to name the specific names, but there wasn't an investor that was looking for the kind of diamond in the rough or super high expectations. And they talked to us. We were like, well, we can't hit that. That is completely unreasonable. You're looking for so much returns. And what happens is if you're convinced that you're going to get so much out of
like a fly-by. I mean, kind of
running just risk.
Exactly.
And this is what essentially what's happened is people thought they'd get the huge returns. What they're really getting was huge risk, and now it's coming back. Yeah. And some of them did get those returns, but now comes the risk.
Yeah. Risk equals return.
Yeah.
The reason why the GP in a deal makes a much higher rate of return is because they're taking on.
Yeah.
So it's a completely different type of risk.
And the number of I was thinking about this. Yes, the apartment market. It's not like 1 million apartments are traded every day, but there is enough that are traded. There's enough transactions that happened. That there's going to be some risk. There's going to be some people that are going to be on the downside of these and aren't going to make it out.
There's always risk, and again, this comes back to why it's a great asset class, and real estate can be in general, but especially residential and multifamily, large multifamily, is that if it all sort of looks the same in the beginning, but you can have a strategy and a set of tactics to go along with it that really quantifies and minimizes risk. It can cap your return in some cases, and the biggest way to do it is, you're going to buy right, clearly, but also you're going to hold it for long enough where you can work through any problems. You're going to use, long-term debt, fixed rate financing, have a relative, conservative assumptions, buy for less than you could build it for. And if you do those things, you can survive almost any market. And even if everything goes wrong, the chance of losing money is so small.
Yeah.
I mean, it's so small. And so it's an investment where it's like the downside, again, if you execute through the right strategy, and it's not something special that we have.
Yeah.
Like I'll be clear, I think I see people doing a lot of different things. We're not, we think we've got our different style, different, tack at it, but it's not right. We didn't invent the wheel. You can really prevent downside and still get awesome returns.
Yeah. I think that the people that had such high expectations, there's going to be, it's almost like the examples are coming of, this is what it means to have such high expectations, is that the risk percentage. And when we'll see perfect examples of you were expecting a whole lot. Well, this is why you were promised that. And there's the downside.
You want to be careful when people either don't know what they do. In general, people who they think they know what they're doing, but they're just moving forward without any sense of direction and the risks. And sometimes that can work out and you catch things at the right time and you're moving forward and you've got the momentum. But if you're just doing things blindly, whether it's false confidence from no success, or just doing it, or you've had enough success where you're just continue doing it away, and when you've got blinders on, you build that machine, it's hard to turn off. And so you need to be aware of, it's something that we've been well aware of, is that if you're an LP and looking at investing with a group, are they feeding a machine, or are they looking at the deal the way you would look at it as well? Is just this another one to fill in a spot in their portfolio and is going to serve some ancillary purpose, and they just need the deal fees, or is it a great investment because it's they're truly excited about it? There's obviously a lot of different shades in there, but there's definitely some of that, and some of that's going to be just kind of coming to light of these people had a strategy and they were just paying whatever because they didn't really care, because they didn't really have any skin in the game. And they were going to get the fees and they were going to worry about it later. And like you talked about on the last episode, I think, Matt, is, and they personally believe probably they can do it. They're confident. They sound like they're confident that they can do it and they'll figure it out. Maybe they will. There's a lot of smart people out there that just took a lot of risk.
There's enough things that happen that where someone will certainly be in trouble.
Matt, okay, CBRE.
These next two pieces of research, there's a couple maps really that I want to go over. Not necessarily like a full report. Yeah, I like maps too.
We already did the boating analogy.
That's right. Yeah.
What was it?
Big boat and tugboat.
Oh yeah.
It's slow.
There's
to
a
turn
couple
around.
other nautical, like the trim tab.
Trim
tabs.
Last week you did the navigating by the stars and I think we'll keep that up. But back to these maps. So the CBRE has a map of multifamily rent growth. Their headline is rent growth is to persist where least expected. Well, we expected it. We were covering it. And it's in the Midwest and a little bit in the Northeast. But RealPage actually, or I'm sorry, Apartment List noted some of the gateway markets. Or no, I'm sorry. It was Marcus and Millichap noted the gateway markets like Boston and New York are doing a little bit better, these coastal markets. But I wanted to...
I would love to move some real estate in those markets.
That's right. But I want to compare the CBRE map, which does show that, the Southwest is not doing so well. The Southeast is not doing so well, except for maybe like Fort Lauderdale and Miami. But like Sunbelt moderation and Midwest and really Northeast were even rent growth,
I've got some dots to connect between these maps and our last report from Harvard Joint Center for Housing Studies.
Oh, yeah. Okay. So now here's the next.
So I queuing you up?
Yeah. And that's what I wanted to show. Now, it's not always perfectly correlated. And I think it is interesting when it doesn't line up. But man, it does seem like the map of population growth aligns pretty well with the map of rent growth. So if you wanna,
that kind of makes sense. I mean, it's not the only factor, obviously, but I mean, it's certainly a major indicator. I mean,
now where it differs is that has been so much supply come into the Sun Belt. You see a lot of population growth in the Sun Belt, but not apartment rent growth because there's been so much apartment supply. There's the supply demand. Now, what I will also say about this is that's kind of why I feel like these apartments will be absorbed, is because we're seeing all this population growth from places like Florida is almost like all the counties in Florida on this map are showing population growth of like 1,000 and over or something. Few far between not, but if you look at the rent growth map, it's different. And the same thing for places like Arizona and Southern California, where rent growth is -10, -5. And population growth is almost diametrically opposed. I said that it was similar. I was wrong. It is different. And if you look in the Midwest, where there's a little bit less population growth, a little bit more scattered.
There's some clear concentration. And then again, this is like, I just keep pumping up the Midwest, but this is where so many institutional investors missed over this cycle. It's because they just saw this and they saw this and they saw this.
They saw that rent growth in the South.
That's all great.
Or saw the population growth in the South.
Exactly. They saw the population growth in the South. And so these prices in the South started getting crazy, but what they were just kind of not missing out on is all this growth here in Ohio. Look at all this red.
And
here in Cincinnati.
Zoom in a little bit into Indianapolis. Indianapolis is an interesting case study of the kind of metropole and the suburbs, this strange inverse relationship when it comes to rent growth or population growth for that matter. Suburbs have been throughout the country have been doing better for rent growth than downtowns. And if you look at Indianapolis, Marion County, has negative 2,181 population change last year. The surrounding counties, if you tally all of those, they're all positive. Or maybe there's a couple of them that are like negative 100. But if you tally all the surrounding counties, you have you fill in that negative 2,000 and you add 10,000 more. So there's about 12,000
to the MSA.
To the MSA if you take in the surrounding counties, and that's that's something that to pay attention to is
same. I think that's the same thing here down in Louisville. Kind of the Jefferson County versus look at Oldham County or Clark County,
and in Chicago you see a couple.
Same thing here out in the suburbs. Cincinnati's the same thing. Hamilton County. But all the suburbs, you're seeing a lot of growth in. But Columbus, I guess, would be a little bit of a sort of an outliner, where all of these counties are growing. But it makes sense.
But then, man, if you scroll down to the Sun Belt, it's so crazy how uniformly it is growing. It makes it completely understandable that there's been so much attention to building there. A lot of people are moving down there. It doesn't seem like it's slowing. Now, the other thing that I've been thinking a lot about is places in the South. And I don't know enough about the weather to talk about climate change, but I know that like some like water things in some of these Sunbelt areas are, if water rights are gonna come up, if they're constrained in that way. So places like Phoenix or Las Vegas or really even like some places in
how are they going to deal with
California? How are they going to deal? And the population growth, they're seeing a lot of population growth, and right now they have a lot of apartment supply. But I wonder how if those populations are going to change if the cost of living there means that you have to pay like a high water bill. I don't think it's going to mean that like there's a crisis that farms are going to start drying up. I think that what happens is
just cost of living
is going to go up, and that's going to be an element of cost of living that people are not used to. That it's just going to be another.
Oh, that's a good point.
Get it right.
Matt, I do want to return, and I don't know if I made the point we were talking about when we were starting to comparing some of these maps, and I guess some of the correlations of some of the southernmost Sun Belt metros that are still seeing positive rent growth and population growth. And that's kind of, it was a lot of to do with this the Harvard Center for Housing Studies a report, and they're really focusing in on immigration and migration.
Yeah, that was the upshot. Yeah, for sure.
And this has been the case for a long time. If we did United States population growth, which again is key to just overall GDP, economic growth, and trickling down clearly to rent growth. If not for immigration, we would have negative growth.
Yep.
Like
if we were just having babies to increase our population,
not having enough babies, and we've got a lot of open jobs.
Yeah.
Not trying to get political. I'm just saying, like, the net benefits certainly outweigh the cost as I perceive them, and we need a lot more people here. And it would be better for the economy if we had more people here.
Yeah,
it would be deflationary.
Yeah.
Anyway, what I'm saying is, immigration is good for the multifamily industry, and we still have people that have been coming in, and we're seeing rent growth really still be, buck the trend of the rest of the Sun Belt in markets that are immediately on the border.
Yeah.
So I mean, looking at like Tucson, looking at, again, Miami, which is, I mean, I know it's like on the ocean and there's all the ocean, but people are coming into Miami. I kind of at the southernmost spots, the southernmost part of LA or California, southernmost part of Arizona.
And it's interesting,
Texas, a lot of these on the population growth, population growth map.
Oh, wow. Like El Paso immigration is the largest component of population growth there. And it is, El Paso may be one of the strongest rent growth in that CBRE map.
It even is true. I don't think it matters. But
in Alaska, you got some Canadians coming north. Now, what you mentioned it, but it is, just to kind of repeat it, it is good for the multifamily industry in a way that's probably even better than have babies. You have a baby, you have to wait 18 years before they're going to get it.
We can get new renters in
right then.
Yeah. Exactly.
Don't have to curl them up. Yeah.
And again, there's a ton of job openings.
Yeah.
People we got jobs that need to get done. And anyway, how the country was built. And again, I see that just the net positives well outweigh. I mean, do it in a way that you don't
choose what country you were born. No one chooses what country they're born in.
I just don't like the government getting involved. And if you're a decent person, why not? And you want to come here and have the American dream? Like, we should be like, how do we get that person here tomorrow?
Totally. But instead, I think we should argue about it for 2, maybe 3 more decades.
Sounds good.
All right.
I mean, and the thing, like we've got it figured out. Obviously, differing opinions. Matt, there's the content that was in today's report. There's a lot of stuff. I mean, we really just scratched the surface. I mean, that's why the newsletter that comes out every Thursday is so important, because it's a really nice digest that you could spend, an hour. You could spend 10 minutes just glancing through. I mean, you could spend 10 seconds and you're going to get data right when you open it up. You can spend 10 minutes. You can spend all day with it and have a really good understanding of what's going on in the market. It is widely read throughout the industry. It's even imitated now, Matt. I mean, there's a couple like things that are close, and one that's actually like literally it's been copied and pasted, which is like it's kind of cool, but like it's great stuff.
Yeah,
we love it, but I mean, people are copying and pasting.
And
the format of the newsletter.
I think follow. We would love for you to follow the Gray Report newsletter. It's a free newsletter, comes out every week, maybe twice a week. I think it's important to follow these reports through the Gray Report or elsewhere if you want.
Get your own opinions and tell us where we're wrong.
But keep an eye on this market, because I think that we're approaching a real transition point and things could shift pretty quickly. In terms of the capital markets and what's the buy and sell.
Pop over to graycapitalllc.com/newsletter to sign up for that report. Make sure you are subscribed to the Gray Capital YouTube channel, which, by the way, you can catch Katrina Green's new podcast and YouTube show, The Complex. It's on the Gray Capital YouTube channel. So if you're already a subscriber, you're going to be getting notifications, which you probably already watched it. I think it's getting more comments on our videos, Matt. Probably. I think the trajectory, Katrina brings a whole other element. Okay. She's going to probably get us more subscribers.
I can't wait.
It's good stuff. So check out that. We've got a new report on loan maturities and updated research brief, couple weeks. You can hop on right now and read the first one though. GrayCapitalLLC.com/report. another one on rent growth / rent dash report.
Yep.
We're going to have to update that one as well.
Yeah.
This new data coming in, Matt, though.
Oh, yeah. It's updated every day.
Because, I mean, the year-over-year average from the report not too long ago.
Yeah.
1.74, I believe.
And then it went down. I did a recalculation to like 1.29. And it,
yeah.
So
yeah.
It's going
so thanks for watching. We appreciate your time. Catch you on the next episode of The Great Report.